The oil price falls and stocks gain on news Iran is seeking de-escalation despite strikes continuing overnight. The Bank of Japan is set to hold rates today amid a hiking cycle, and extra May holidays boost Chinese retail sales and suppress production. That's coming up in our 5 Things in 5 Minutes on Tuesday, June the 17th. And then in our deep dive interview, ANZ senior commodities strategist Daniel Hynes analyses the ability of OPEC producers to respond to any disruption to oil supplies amid the current conflict.
Saudi Arabia, which holds about half of that spare capacity, could effectively bring that on relatively quickly.
But first in 5 and 5 with ANZ, I'm Alex Tarrenton for Bernatiki. Oil fell and stocks gained on news Iran was seeking de-escalation of the conflict with Israel. However, strikes continued from both sides, even as reports indicated Iran was seeking those talks and may be open to resuming negotiations on its nuclear program. Here's ANZ economist in London, Bansi Madhavani.
In terms of financial market implications, so far it has been an extraordinary year of geopolitics, of regional conflicts, but markets are holding up. Following the news of Iran seeking ceasefire, financial markets rallied on the hopes that the conflict will stay contained. Oil prices fell as well. Now, that's not to say that volatility will ease. If anything, it's an evolving situation and financial markets will remain on the edge.
At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.91%. The 10-year US Treasury yield was up 2 basis points at 4.44%. The gold price was down 1.19% at $3,411 an ounce. In West Texas Intermediate futures, they were down 1.88% at $71.61 a barrel. The US dollar index was down 0.18%. The Aussie dollar rose 0.79% to 65.40 US cents, while the Kiwi was back up 1% at 60.72 US cents. Number 2. With the US dollar softer overnight, ANZ head of FX research Marjbeen Zaman analyses how it has tracked in recent days at a time where it has also been losing some of its safe haven status.
The rise in the US dollar on Friday is likely attributed to increasing oil prices and the positive correlation that oil prices and US dollar now have rather than any safe haven flows. Now, yesterday we did see that the US dollar was unable to benefit further from the geopolitical tensions in contrast to the initial reaction seen on Friday. We saw the dollar rise along with oil prices. Now, the softer dollar could be on the back of oil prices now consolidating at higher levels from late last week, but unable to move to a new leg higher. Could be that markets are not really as concerned about energy supply despite the attack on Iranian oil fields.
Number 3. The Bank of Japan has a rate call today. Expectations are for a hold at 0.5%. ANZ international economist Tom Kenny says the BOJ is looking for how resilient the Japanese economy is to the global tariff shock.
Recently, Governor Ueda stated that the Bank of Japan wants to see how tariffs impact the data in coming months. This to us suggests a lengthy pause on the policy rate. That said, Ueda thinks the Japanese economy will be resilient to this trade policy shock, and significantly he believes that the virtuous cycle between wages and services inflation remains intact. We would agree with that assessment, and as such, we think the Bank of Japan will hike by 25 basis points in October, and then again by 25 basis points in April 2026.
Number 4. Marjbeen says a key focus in coming days is the pace of Japanese government bond purchases.
Currently, the BOJ is shrinking its balance sheet by 400 billion yen every quarter. There are consensus estimates that this could be reduced to 200 billion per quarter starting in April 2026. Looking ahead, the Ministry of Finance is set to meet with market participants on 20th June to discuss issuance plans and better understand market appetite for JGBs. I think this meeting is probably going to be quite meaningful for markets, especially after we saw the lack of demand for 30-year and 40-year JGB auctions a couple of weeks ago.
Number 5. China retail sales surprised to the upside in May, up 6.4% annually. Meanwhile, industrial production was up only 5.8%, lower than in April and the slowest since November 2024. ANZ senior China strategist Zhao Pangjing says 2 additional days of holiday in May means both swings will be temporary.
I don't think it's a sustained improvement for China consumption. The big picture for China economy is this year will continue to be a very strong production, but weak consumption. It's very hard to boost the consumption or boost the consumer confidence with the current policy measures. I think the authorities will have to do more.
Zhao Pangjing there. Now in our deep dive interview, ANZ senior commodities strategist Daniel Hynes analyses how the Israel-Iran conflict escalated over the weekend and how global oil and gas supplies could be affected if tensions did escalate.
Certainly, the initial attack that Israel launched on Iran obviously focused on its nuclear facilities, and so there wasn't any initial sort of disruption to any sort of supplies of oil or gas. But certainly, things ramped up over the weekend. Israel subsequently hit a gas processing facility as well as an oil refinery, and so the fears of the energy industry being dragged into this conflict obviously ramped up quite significantly. I suppose now the question being asked is whether Iran itself retaliates with unconventional sort of methods aimed at the energy market. And it's clearly a tool it's threatened to use in the past. It has looked through its proxy militant groups to disrupting oil supply, in particular in the Red Sea. But it is obviously sitting on one of the most important transit points for the energy market. So any sort of effort by Iran to disrupt flows through the Strait of Hynes clearly ramps up the risks to the energy sector.
How could they disrupt those flows, and what could it mean for oil and gas markets?
Yeah, well, initially, and this has been the case for 20 months or so, has been supporting those proxy militant groups to launch attacks. Now, Israel has gone a large way to disarming those groups following the attack by Hamas on Israel. And so that ability to utilise that lever is clearly constrained. Iran would have the potential to potentially threaten or harass ships moving through the strait, and it has done that in the past. Obviously, the worst case scenario would be for Iran to effectively block the strait. They could do that through putting mines in that waterway, which would really close down exports from countries like the UAE, Qatar, Iraq, those major producers sitting on that waterway. And, that would potentially put at risk some 17 million barrels of oil.
And that could affect natural gas markets as well?
Yeah, well, certainly Qatar is one of the biggest LNG exporters in the world, and any obviously closure of that strait would impact those supplies immediately. The other avenue where we could see some impact on the LNG market is actually through Israel. So Israel itself exports gas to Egypt in particular. Egypt's actually consuming a huge amount of LNG at the moment due to strong domestic demand, and that thus would force them onto the spot market, tightening that market up as well. So the flow-on effects could be just as great for the LNG market.
How well is the oil market equipped or prepared to handle this sort of disruption, and how does that compare to previous times like this?
Yeah, well, I think at the moment it's probably the best place it has been for some time. OPEC has obviously been trying to manage or stabilise the oil market through a variety of production cuts, and that has left it with a huge amount of spare capacity. In fact, it's outside of COVID-19 when they shut down a huge amount. It's pretty much at near its record levels of just over 6 million barrels a day. So Saudi Arabia, which holds about half of that spare capacity, could effectively bring that on relatively quickly. So, look, it's relatively well placed, at least to replace any sort of supply initially coming through Iran's exports being impacted. Clearly, that worst case scenario of the Strait of Hormuz being shut down would be difficult to ultimately replace. But I think when you look back historically, this huge amount of spare capacity has been tempering sort of factor on oil prices in the past. And so this time around, I suspect the market will take some comfort that even if supplies are disrupted, the tightness in the market would be relatively short-lived as OPEC ramps up output.
Daniel Hynes there. I'm Alex Tarrington for Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, June the 17th. Catch you tomorrow with analysis of US retail sales data and a look ahead to the FOMC rate decision this week.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.